We welcome into the stream Professor Nouriel Roubini. He is professor of economics at New York University's Stern School of Business. He is also the CEO of Roubini Macro Associates, LLC. We also welcome back Julia LaRoche. She is a correspondent here at Yahoo Finance. She has actually invited Dr. Roubini to join us, so I'm going to throw it to you, Julia, to lead off the question.
Thank you so much, Adam. And Nouriel, it's great to have you on, as always. A lot to unpack here. You put out a piece ahead of the election. It was pretty prescient. So would love to kind of explore your views as to what's transpired here, and what are the implications for the economy?
Well, it looks like it's going to be divided government, with Biden most likely winning the White House, but the Senate may remain Republican, unless those two runoff elections in early January in Georgia would lead to a 50-50, in which case Kamala Harris could break the tie. But I would say for now that doesn't look likely. Now, in terms of the economy, implies that, of course, the amount of fiscal stimulus is not going to be as large as the one that you would have had under a blue wave. Biden wanted over $2 trillion of a stimulus plus another $2 trillion of spending on infrastructure and on a Green New Deal over the next 4 years. So in the short run, of course, this week the stock market rallied because they believe that divided government is good. And why they believe this divided government is good? Because Biden wanted to increase taxes, corporate taxes from 21 to 28%, close a bunch of loopholes, especially on foreign profits of big tech and pharma, raise taxes, personal income on those that are wealthy above 400,000, and increase the capital gains tax. So in the short run, divided government implies that you have less fiscal stimulus and you don't have a tax increase. However, in my view, the economy is weakening. We've forgotten this week that we have 120,000 new cases of COVID every day. And in the case of Europe, my estimate is that with the rise of cases in Europe, Europe is already going into a double-dip recession in the fourth quarter and the first quarter of this year. I think at this point, with the new lockdowns you're seeing in Europe, we're going to see a double-dip recession in Europe. In the United States, even if you don't have draconian lockdowns like those they're going to have in Europe, the endogenous behavior of the private sector when you have a rise in COVID cases means people are more risk averse, more uncertain, they spend less, they save more, they do less capex, they'll do less employment. So we're going to see that while the third quarter looked like a V-shaped recovery, 33%, the fourth quarter is going to be barely 2%, even less than that. And that's annualized, means that within the quarter, the growth is 0.5 when you have 2% annualized. So I think that actually the economy risks to be weakening because you don't get enough of a fiscal stimulus that you need. And that could be bearing negatively on the market over time, not in the short run, but over time, once we realize that we're having a V that becomes more like a U with a risk of a double-dip recession.
Okay, so a few things there. It looks like, in your view, we could get less fiscal stimulus. You also talked about the rise in COVID cases in Europe. Some of that economic data out of Europe already starting to roll over. And then, of course, the rising cases here in the U.S. And outlining your view of the economy of a double dip here. When we've talked several months ago, we've talked about this kind of risk of a greater depression. And I know you have brought up various letters. And I believe the last time it was a double dip recession was the risk that you saw. Nouriel, when you look at that, I guess that would be the W shape. Does the latter half of that, could that be worse than the first dip we saw? Would like to kind of double click on that as well.
Well, you know, the free fall that we had in the first quarter and the second quarter of this year was massive because we had to shut down economic activity altogether, first in China, then in Europe, then US, then globally, in order to flatten the curve and reduce the spreads of the virus. Then we had a very sharp recovery in the third quarter. Even if we have a slowdown or even a double dip, in my view, we're not going to have the free fall of economic activity we had in the first and the second quarter of this year. But, you know, whether it's going to be a mediocre anemic U with unemployment rate remaining high and massive defaults and bankruptcies, or whether it's going to be something more severe like a double-dip recession, the difference is relatively small, meaning we're not going to have 30% growth anymore. It was just a one-quarter event because after a free fall in the second quarter, we had a recovery, and the annualized rate, they look like 30, even if within the quarter was only 7%. But I expect in my baseline a mediocre anemic, subpar, below trend recovery. That means that lots of people are going to suffer. Let's not forget there are still over 10 million people that lost jobs in March and April who have not regained those jobs. And once they regain jobs, they're going to be part-time gig workers without full benefits, low wages, freelancers, contractors. The corporate sector wants to have flexibility. That means that these precarious jobs are going to become the new norm, leading to economic fragilities, more uncertainty, more income and wealth insecurity.
Nouriel, just going off of that, I mean, that's interesting what you're saying about the labor market, because I think that was a lot of questions here going into what we just saw today. I mean, it was a better than expected report. I was going through a number of analyst commentary saying that the jobs picture is actually better, and we're pacing better than what the Fed was even expecting on an unemployment rate level. It sounds like you're pouring cold water on that, though.
Well, you know, the economy is improving. We're creating jobs. But the reality is that you still have, first of all, over 10 million unemployed people. And if you use the U6 definition of unemployment rate, that is the one that includes discouraged workers that have left the labor force, or those who are working part-time but would like to work full-time, that number is still 12%. That is huge by any standard. So is there an improvement in the economy? Yes. Is it really, for those that have precarious jobs, a good economy? No. And is there a risk that now, without adequate fiscal stimulus, and even the Fed, even Jay Powell says, let's err on the side of more stimulus rather than less, because at worst, the economy recovers stronger, sooner, and that's fine. But we're going to have now a situation in which you're not going to have a fiscal stimulus in a lame duck Congress. And once Trump realizes he's not going to be president, he has no incentive to give $1 trillion or $2 trillion stimulus to Biden. Remember, when Obama came to power during a severe recession, there was not a single Republican who voted for that stimulus. This time around, the Republicans are going to say, we're not going to help Biden, let the economy rot, because we're going to have a chance in 2022. So we'll have gridlock like the past. We're not going to have enough of a fiscal stimulus. The economy is going to weaken, and that's going to be something that eventually is going to bear negatively on the market.
3.7 million permanent job losses because of the pandemic. That's the data today from Bureau of Labor Statistics. Yesterday, we heard this issue of a liquidity trap, that interest rates are so low and savings are so much higher right now that what the Fed is doing may not be working. Powell said, no, it's working. What do you think?
Well, you know, the Fed has done its own share, but even the Fed believes that there are limits to what monetary policy can do, and that the stimulus should be coming from fiscal policy, because we're running out of bullets on the monetary. And the monetary side, more than stimulating the real economy, is stimulating asset prices. We're talking about the shape of the recovery, whether it's a V or a U or a W. It is certainly what most people call a K, because those who have stable jobs, white collar, and have financial assets now have jobs, have income, and their financial assets, like their equity wealth, is going up in value. But suppose that you are permanently unemployed, or you're underemployed, or you're at risk of losing job, you're also among the people that has almost no financial wealth. Just to give you a number, 85% of all equity wealth in the United States is held by the top 10% of households. 51% of it is held by the top 1% of households. The bottom 50% of households has almost zero equity wealth, 0.5%. And the top 60 billionaires in the United States have more wealth than the bottom 50% of the population, that is 160 million people. So this is a K-shaped recovery. Those who have income and have assets are doing well. Those who are fragile and don't have income, or don't have jobs, or have fragile jobs and don't have financial assets, are in deep trouble. We are a very divided society between haves and have-nots, between winners and losers, and that's why there is so much social unrest.
Nouriel, I do want to kind of talk about markets for a second, and also different asset classes. One in particular that's getting a lot of attention lately, Bitcoin. The price I'm looking at now, it's above $15,378 for a single Bitcoin. What is your view of the cryptocurrency? And we're hearing a lot of folks who are pretty bullish on it these days.
Well, first of all, I've pointed out that cryptocurrency is a misnomer, because for something to be a currency, you have to be a unit of account. Nothing is priced in Bitcoin or any other cryptocurrency. You have to be a single numeraire, and with so many tokens, you don't have a single numeraire. You have to be a scalable means of payment, and with Bitcoin, you can make only 5 transactions per second. With a Visa network, you can make 25,000, and you have to be a stable store of value that is not very volatile. Now, based on the first few criteria, Bitcoin is not a currency. It's maybe a partial store of value, because unlike thousands of other what I call shit coins, it cannot be so easily debased, because there is at least an algorithm that decides how much the supply of Bitcoin raises over time, because for most of those other ones, literally is done ad hoc, and they're being debased faster than what the Fed is doing. So what's the future of this asset class? In my view, is not scalable, is not secure, is not decentralized, is not a currency. And remember, many central banks, starting now with the Chinese one, the Swedish, but even the Eurozone, are starting to think about creating a central bank digital currency. Once you have a central bank digital currency, every individual can use an account with the central bank to do payments. So not only you don't need crypto, you don't even need Venmo, you don't even need a bank account, you don't even need a check. And the big revolution we're going to see in the next few years is going to be central bank digital currencies. They're going to be crowding out digital payment systems that are in private sector, starting with cryptocurrencies that are not really currencies.
Nouriel, I mean, what you're saying now will have such broad implications. It's kind of hard to wrap your head around that. But I just want to bring the conversation back to what we're seeing in the markets play out today and what we've seen this week, because I think the market's reaction to an uncertain election, 3 days since election day, we still don't have an outcome or a better picture, I think, of who exactly is going to be in the White House. But more broadly speaking, I'm curious just to get your take on the fact that the polls are wrong once again. I think Trump's coalition provided to be much stronger than many had anticipated. And that leads to the fact that the country is so divided. I'm just curious just what kind of risk you think this might bring to the economy and what risk it could bring to the market here over the next couple of years.
Well, you know, a week before the election, I wrote a piece saying that the polls were most likely wrong, that there'd be a narrow margin, and that therefore there'll be a high contestation of this election. And we'll see, by the way, how much Trump is going to accept the results, as opposed to start first legal action and then court action, and maybe even unleash his Proud Boys in the streets trying to create chaos. So if that were to happen, by the way, I would expect that a severe risk-off episode would occur if we're going in the direction of civil unrest, if not violence. And I don't rule it out. It's not my baseline, but it's one I'm not ruling out. But I think the results of the election suggest that we are a very, very divided society. And we're going to be in a situation in which, because of divided government, we have gridlock. I would rather have a political system where the winner has all the power, and the party that wins for 4 years, like parliamentarian systems in Europe, they can do what they want. And if they do the right thing, they get reelected. And if they don't do the right thing, they're booted out of power. In the US, we have the worst of all systems, because we have divided government. We have a situation which you need 60 votes in the Senate in order to pass anything, unless you do to reconciliation. And even if you win the White House, then you cannot have your agenda. That's what happened to Trump when you had a majority in the House being Democrat, and that's what's likely to happen right now if Biden wins and you're going to have a majority in the Senate being Republican. This kind of a gridlock doesn't make sense, because whatever your views are, if you're in power, you have to do structural reforms. You have to take policy actions in one direction or another. And this gridlock is like kicking the can down the road, running larger budget deficits, not deciding to cut spending, not deciding to raise taxes. And we have huge deficits. We're monetizing them, and we're effectively in helicopter drop of money policies, what people call MMT, that eventually may lead to a rise in inflation, if not stagflation. So this gridlock, in the short run, the market rallies, is excited about it. But if you think about it, having gridlock for another 2 years and what it implies for the economy is not good for the economy, and is not going to be good for the market, in my view.
So in 2021, you don't see a President Biden and a Senate Leader McConnell actually forging some kind of deal for some kind of stimulus greater than the $300 billion the Republicans were proposing, but less than the $2 trillion the Democrats wanted?
Well, I don't see it for the following reason. If you're a Republican and you just lost the White House, what's your interest? Your interest is to make sure that the economy is weak, that Biden as a president cannot do anything but by executive orders that are going to be challenged in the courts. And then if the economy is weak 2 years from now in 2022, then the buck stops with the president. And the Republicans are going to say, look, the economy was mediocre and don't vote for the Democrats. Why would they want to give a $2 trillion stimulus or even 1.5 to the Democrats? It's going to boost the economy, it's going to boost jobs, and it's going to make the Democrats look good in 2022. From a purely partisan point of view, you want them to fail, right? That's what happened with Obama. When Obama came to power, there was not a single Republican who voted for that stimulus in early 2009, in spite of the fact that we were in the deepest one of the recession during the global financial crisis. I think we're so divided, we're so partisan that I don't see the chances of bipartisanship emerging. Yes, there will be a stimulus. Whether it's going to be 300 billion or 500 billion, it doesn't matter. It has to be well above $1 trillion to make a difference. I don't see this Republican going for it. Certainly not Trump at this point being lame duck.
You know, Nouriel, when you talk about the division and that we're seeing here play out within our own borders, I guess sometimes it could be, we don't necessarily think beyond what else is going on globally. And I know you're someone who does look out into the global landscape, and you usually come out with kind of your white swans. I know that was something you wrote earlier this year, the white swans taking place. What is something happening beyond the US that we need to be paying attention to? And if we are divided internally, that could have some serious ramifications for our country.
Well, first of all, we are on the verge of a process of what I call deglobalization. Everybody's going to become more protectionist. There's going to be deglobalization. There'll be decoupling between US and China. There'll be a fragmentation of the global economy. There'll be reshoring of investment from China and Asia to high-cost sources of production, stuff that reduces potential growth and increases the cost of production. It makes the risk of stagflation rising. The second thing, I think, is unfortunately, we're at the beginning of a Cold War between US and China that have a completely different economic, political, and social system. And therefore, the decoupling is starting first in technology, then in trade, then in financial flows, then in investment, then in data, then in information, then in mobility of scholars and students, and so on and so on. And if we're going to be a world that is divided in two, one led by the US and the West, and the one by China, those are going to be two different economic, trading, financial, political, and geopolitical system. Again, that's not good for the global economy. And things could get even worse between US and China. The Cold War could become colder, and some people even worry about a situation where maybe even a military conflict down the line could be the kind of a extreme tail event that might materialize on Taiwan or on the South China Sea. So there's plenty of other stuff, of course, that can go wrong globally.
Nouriel Roubini, we really appreciate you taking the time. We love your honesty. We love what you had to say. We look forward to having you back on the program soon. Thanks so much for taking the time.
Thanks for having me. Pleasure.